Imagine looking at your insurance company's balance sheet and seeing like $100 million in pure profit. You're popping champagne.
Right.
The shareholders are thrilled.
Right.
But what you don't know is that a massive hailstorm just leveled 3 neighboring states. A fleet of your insured commercial trucks was involved in a multi-car pileup, and, well, your profit is actually already completely gone.
It's just vanished.
Exactly. The phones just haven't started ringing yet to tell you that. So welcome to today's deep dive, specially curated for the Insurance Study Companion. Today we are demystifying the absolute bedrock of insurance accounting, which is the loss reserve.
Yeah, and that scenario you just described, that is the ultimate nightmare for any insurance executive.
Yeah.
I mean, if an insurance company does not have a scientifically rigorous method for anticipating the cash that will inevitably have to go out the door, that $100 million in profit is just a dangerous illusion.
It's totally fake.
Exactly. You cannot understand the true financial health of an insurer or, frankly, pass a CPCU exam without really understanding how this mechanism dictates a company's survival.
Okay, let's unpack this, because before we get into the crazy, the high-stakes survival stuff, let's start by tearing down what this concept actually means in practice.
Right, the basics.
So the simplest definition we have from the source material is that a loss reserve is an accounting estimate of money set aside to pay for future claim obligations arising from insured losses. But the critical word there is estimate.
Yeah, it's always an estimate.
Right. We are fundamentally talking about predicting the future costs of a mess that has already happened.
It is entirely about predicting the future. And to do that accurately, an insurer has to account for basically 2 distinct categories of claims. The first is, well, it's fairly straightforward. It's called case reserves.
Okay, case reserves.
Yeah, these are for claims where the insurance company already knows about the incident, but the file just isn't closed yet. The accident happened, the policyholder called it in, but maybe the final medical bills haven't arrived yet, or the auto repair shop hasn't finished the work.
So it's like the company has the physical file open on a desk.
Yeah.
They just don't have the final invoice.
Right, exactly. You know it's there, you just don't have the final receipt. But the second category, this is where the math gets incredibly complex. It's known as IBNR.
IBNR, which stands for incurred but not reported.
You got it.
Meaning, like, the disasters happen in the physical world, the liability actually exists, but the insurance company hasn't received a single phone call or notification. Wait, so how do you even begin to put a number on something you literally can't see?
That is the multi-million-dollar question. I mean, think about that weekend hailstorm you mentioned in the intro.
Yeah.
The roofs are destroyed on a Friday night, right? The losses have been, quote-unquote, incurred. But homeowners might not climb up to check the damage or, realize they need to call their agent until Monday morning or maybe even weeks later.
Oh, wow. Yeah.
So for that entire gap in time, the insurance company has IBNR liabilities. The obligation is very real, even if the paperwork hasn't even started.
And it isn't just like weekend weather delays, right?
Yeah.
If we think about complex commercial liabilities like environmental contamination or asbestos exposure, a loss could be incurred literally decades before someone actually gets sick and reports the claim.
Decades.
Yeah. And the company has to hold funds for that today.
Which is wild, right? And that requires actuaries to look at just vast amounts of historical data to identify patterns. They ask themselves, okay, historically, when we write 1,000 commercial auto policies, how many claims are reported a month later, a year later, or 5 years later?
Oh, so they're looking at the lag time.
Exactly. They use those historical reporting patterns to estimate the invisible claims that are happening out there right now.
Okay, so if we trace the life cycle of a single dollar through this system, the chronological sequence is super critical for you listening. First, the claim happens out in the world.
Yep.
Second, the company estimates the total future cost. Third, they establish the loss reserve on their books. And fourth, which could be years later, they actually pay the claim.
Right. And we need to clarify what establishing that reserve on the books actually looks like, because a loss reserve is an accounting liability. It is a recognized debt on the balance sheet.
Right. It's not cash.
Exactly. It is not a literal pile of physical cash sitting in a locked vault somewhere.
The sources use this savings jar analogy, which I think is helpful. But it's more like, well, it's more like realizing you haven't opened your credit card bill yet. You know you went to the store and spent the money.
Yeah.
You know the debt exists. You just have to account for that liability against your current checking account balance.
Yeah.
Otherwise, you're going to think you're way richer than you actually are.
Right, which is dangerous. Premium is the cash flowing into the company. The loss reserve is the obligation pulling that value back out.
So let's see how messy this gets when those educated guesses actually collide with real-world litigation and, skyrocketing medical costs. Let's look at a commercial auto policy covering a regional trucking fleet.
Okay, a trucking fleet.
Yeah, so one of those commercial trucks is involved in a severe highway accident.
Yeah.
The initial reports come in, and the claims adjuster has to establish that case reserve.
Right, because the claim is known.
Exactly.
Yeah.
So they look at the initial police data, and they estimate, let's say, $120,000 for property damage to the vehicles.
Okay.
Then they estimate $280,000 for the immediate medical expenses of the injured parties. And because the injuries are severe, the legal department chimes in and anticipates a lawsuit that could cost an additional $600,000 to settle.
Oof. Okay, so the total of those three estimates isn't even $1 million.
Right.
So at that exact moment, the insurer establishes a $1 million loss reserve. They immediately record a $1 million expense on their income statement, which instantly drops their reported profit for that quarter, and they add a $1 million liability to their balance sheet.
But let's play this out in the real world. Fast forward 2 years. The lawyers negotiate, all the medical treatments finally conclude, and the company manages to actually settle the entire claim for just $920,000.
Okay, so they save some money.
Yeah, they cut a final check for $920K. But wait, they had a $1 million liability sitting on the books for 2 years. So what happens to that leftover $80,000? Does it just vanish into thin air?
Well, corporate accountants certainly wouldn't allow that.
Right.
This introduces the mechanism of reserve development. As a claim progresses, that initial estimate, it develops toward the ultimate reality. In your scenario, the company was actually a bit conservative. They overestimated the cost by $80,000.
Which is a good thing, right?
Yeah. That results in what we call a reserve release. The liability on the balance sheet is reduced by $80,000, and that amount flows back into the company's current earnings as a positive adjustment.
Wow, okay. So finding out a past disaster wasn't quite as catastrophic as you initially guessed essentially creates a sudden burst of profit today. It's kind of like financial time travel.
Financial time travel, yeah, that's a great way to put it. But the mechanism works both ways, and the reverse is incredibly dangerous.
Oh, I bet.
Suppose the lawsuit goes terribly for the trucking company. The jury awards a massive verdict, and the final cost isn't $920K, but actually $1.2 million.
Zeeks.
Right. And the company only reserved $1 million 2 years ago, so they are short by $200,000.
Which means they have to cannibalize today's profits to pay for yesterday's bad guess.
Precisely. That scenario demands reserve strengthening. The company has to take an unexpected $200,000 expense out of their current earnings to cover a mistake they made years prior.
That sounds awful for the balance sheet.
Oh, it is. If an insurer is consistently strengthening its reserves year after year, it means their initial estimates are systematically flawed. It's a massive red flag for investors, and especially for regulators.
And that structural tension, I think, brings us to the broader implications. Here's where it gets really interesting.
Yeah.
Because if the entire foundation of the company's profitability is based on these constantly moving targets, how does this volatility impact the rest of the business? Like, if I'm an underwriter, for instance, evaluating risk and deciding who to insure, bad reserves must completely blindfold me.
Completely. Underwriting relies entirely on accurate feedback from the claims department. Let's say an underwriter builds a massive portfolio of trucking policies, right?
Okay.
If the claims department is systematically under-reserving the accidents that occur, meaning they are setting the estimates way too low, that trucking portfolio looks highly profitable on paper.
Oh, I see.
Yeah, the underwriter thinks they are a genius, they write even more of those policies, and they might even get a huge bonus.
Meanwhile, they are actually stuffing the company full of totally toxic risks.
Exactly.
The true cost of those policies is being hidden by those artificially low reserves, which creates this super dangerous illusion of success that is, eventually going to collapse.
And that collapse directly triggers a crisis in the second key area we need to talk about, which is pricing.
Right.
Historical loss data is the primary ingredient for calculating future premium rates. If a company underestimates its losses today, they aren't going to charge enough premium tomorrow.
So it basically creates a devastating lag effect.
Right.
If the company wakes up 5 years from now and realizes they've had to do massive reserve strengthening on all those old trucking policies like we talked about, they suddenly have a huge hole in their balance sheet.
Yep.
And the only way to fix it is to panic and hike rates astronomically on today's customers.
which then makes them totally uncompetitive in the market. Accurate reserving is really the only way to maintain stable, competitive pricing for consumers, and this relies heavily on the third area, claims management.
The folks in the trenches.
Exactly. The claims adjusters are the ones on the front lines continuously revising these estimates. When they receive a new medical prognosis or, when a plaintiff files a new motion, the adjuster must recalibrate the reserve.
It sounds like the adjuster's ability to accurately reserve a file is a direct reflection of whether they actually understand the severity of the claim they are managing. I mean, if the reserve is stagnant while the litigation escalates, the adjuster just isn't doing their job.
Yeah, that's exactly right. Which cascades directly into the fourth and perhaps most heavily scrutinized area, financial reporting.
Oh boy, the accountants.
Right. For property and casualty insurers, loss reserves are typically the largest single liability on their balance sheet. Because any change to the reserve immediately impacts current earnings, the moral hazard here is just immense.
Let's unpack that moral hazard.
Yeah.
Because if a C-suite executive is staring down a bad quarter and their annual bonus is tied to hitting a specific profit margin, I mean, there must be a massive temptation to pressure the claims department to just artificially lower the reserves.
Absolutely.
Because releasing reserves inflates current earnings.
The pressure can be subtle, or it can be overt, but the temptation is a known reality in corporate finance. Temporarily suppressing reserves makes the balance sheet look stronger and props up the stock price. But, and this is a big but, it is a ticking time bomb.
Because the cash will eventually have to be paid out.
Exactly. The bills come due. And this is why the fifth area is so critical: regulation.
State insurance commissioners aren't just taking the executive's word for it, right?
Yeah.
I mean, they must have dedicated teams hunting for these artificial manipulations to protect the public.
Oh, they do. Regulators monitor reserve adequacy relentlessly to ensure solvency. Solvency basically means the insurer actually possesses the financial capacity to pay all their future obligations.
Right.
If a regulator's audit reveals historically inadequate reserves, they will intervene. They can force the company to raise capital, they can halt them from writing new business, or, in extreme cases, they can take over the company entirely.
So to prevent executives from cooking the books and to keep regulators at bay, who acts as the referee here? Who was doing the hardcore math to ensure these estimates are actually grounded in reality?
Well, this is the domain of the actuary. Actuaries are the highly specialized professionals tasked with evaluating the adequacy of the total reserves at a macro level.
Okay.
While a claims adjuster estimates the cost of a single truck accident, an actuary uses really complex mathematical models like runoff triangles to analyze the entire portfolio. They factor in inflation, changes in legal precedents, and, broader economic trends.
So the actuaries are essentially the immune system of the insurance company. They have to find the absolute truth right in the middle. Because if they let the reserves sit too low, the company pays out dividends it can't afford and risks bankruptcy.
But wait. What if the actuaries are too conservative and set the reserves way too high?
If we connect this to the bigger picture, then the company suffers a different kind of death. Profits look artificially depressed.
Oh, right. Investors flee, stock prices plummet, and the company needlessly overcharges its customers, meaning they lose market share to competitors who price their products accurately. Actuarial science is just a continuous high-wire act of precision.
Knowing the massive real-world stakes of this high-wire act, let's pivot to how this knowledge is actually tested. Because a large portion of you listening right now are learners, specifically CPCU students, getting ready to sit for exams.
Yes, the exams.
The exam writers know this topic is foundational, and they know the terminology is a complete minefield for beginners. So let's break down the 3 major exam traps students inevitably fall into.
Good idea. Exam writers love testing loss reserves because the intuitive assumptions you'd make are almost always wrong from an accounting perspective. Trap number 1 is the assumption that a reserve equals cash.
Oh, it's the savings jar misconception again. So a student might read a multiple-choice question that lists various financial vehicles and asks which one represents a liquid asset.
Exactly. And the exam will specifically offer loss reserve as an option to catch students who think it's a segregated bank account full of cash waiting to be deployed.
Which it isn't.
Right. A loss reserve is never an asset. It is an accounting liability representing a future obligation. It literally sits on the opposite side of the balance sheet from the cash.
Got it. Okay, trap number 2 is conflating the reserve with the actual claim payment. So a scenario on the test might describe an adjuster establishing a $50,000 reserve for a fire claim and then ask the student what step in the claims process just occurred.
And the incorrect TREP answer will be claim settlement or indemnification. Establishing a reserve and paying a claim are distinct chronological events.
Right.
The reserve is merely the initial recognition of the debt. The payment is the execution of that debt, which happens later and actually reduces the reserve back down to zero.
Okay, so trap number 1 and 2 deal with the mechanics. But trap number 3, this is purely about navigating confusing terminology, and this is where I really want to push for a definitive breakdown. The trap is, loss reserve does not equal unearned premium reserve.
Oh, yeah.
To a beginner, they both contain the word reserve, and they are both liabilities. Where is the unbreachable wall between these two concepts?
The confusion is incredibly common, so don't feel bad. The key to separating them is to look at the timeline. Are we looking backward at a disaster that already happened or forward at coverage we haven't provided yet?
Okay, backward versus forward.
Let's isolate the loss reserve first. It is fundamentally backward-looking. It exists to fund the future payment of past losses. The accident has already occurred. Because it deals strictly with the cost of claims, it is classified on the balance sheet as a claims liability.
Past accidents, future payments, claims liability.
Okay.
That makes sense. Now, contrast that entirely with the unearned premium reserve.
Right. The unearned premium reserve has absolutely nothing to do with accidents or claims. It is based entirely on the policy contract term. Imagine you pay your auto insurance premium for the next 12 months in a single lump sum today.
Okay, I hand them the check.
The insurance company has your money, but they haven't actually provided 12 months of protection yet. They haven't earned that premium.
Yeah. So they have to park that cash in a specific holding area on the balance sheet. Because technically, if I cancel my policy tomorrow, they owe me 11 months of that money back.
Right. They place it in the unearned premium reserve to fund their future coverage obligations. As each month passes, they earn a portion of it, and they move it from the reserve into actual revenue.
Oh, I see.
Because this reserve deals strictly with premium dollars owed back for unexpired time, it is classified as a premium liability, completely separate from a claims liability.
Let me just synthesize that to make sure it's bulletproof for everyone taking the exam. A loss reserve is a claims liability that holds money for things that already went wrong. An unearned premium reserve is a premium liability that defers revenue for protection you haven't provided yet. One deals with the mess of the past, the other deals with the promise of the future.
That is exactly it. That is the exact distinction that will secure you the points on the exam. Do not let the shared word reserve trick you into treating them as the same mechanism.
Awesome. All right, as we pull all these critical threads together, let's lock in a rapid-fire synthesis of everything we've covered. The sequence is absolute. The claim happens out in the wild. The adjuster or the actuary estimates the cost. The company establishes the accounting liability known as a loss reserve. And, eventually the payment is made.
Then we must also retain the division within those estimates. Case reserves account for the known disasters sitting right there on the adjuster's desk. IBNR, incurred but not reported, accounts for the invisible disasters, the hailstorms, the toxic exposures, the accidents that have happened but haven't yet triggered a phone call to the agency.
And the accuracy of those estimates basically dictates the survival of the entire enterprise. Artificial reserve releases create phantom profits, while reserve strengthening destroys current earnings to pay for the sins of the past.
Exactly.
This single metric drives underwriting decisions, it dictates consumer pricing, and it completely determines whether state regulators will allow the company to keep its doors open.
Which leads to, I think, a really crucial realization about the actuarial science underpinning all of this. We noted that actuaries rely heavily on historical data patterns from the past to estimate the cost of the future.
Right, and that raises a profound and frankly terrifying question about where this industry goes next. So what does this all mean for the future? If the entire bedrock of insurance accounting assumes that historical data is a reliable predictor of future claims, what happens when the nature of risk fundamentally changes overnight?
That's the scariest part. Think about the rapidly changing modern landscape. We are seeing unprecedented extreme weather events driven by climate change that just totally defy 100-year historical models.
Wow, yeah.
And we are witnessing sudden, widespread cyber attacks that can simultaneously cripple thousands of interconnected businesses globally in a matter of seconds. If the past can no longer predict the frequency or severity of the future, how can actuaries possibly adjust their loss reserves fast enough before tomorrow's unprecedented claims wipe out today's reported profits.
It completely challenges the very definition of an educated guess.
It really does.
It is a question that every underwriter, actuary, and CPCU student is going to have to grapple with as these models are pushed to their breaking point. Because, as we've learned today, if you haven't correctly anticipated the true cost of tomorrow, your financial health today is nothing more than a mirage. Thank you for joining us for this deep dive. Keep pushing through the material, trust the process, and we'll catch you next time.